Hello and welcome to the video. We've got another addition to the technical analysis series. This video is on market structure. Apologies for the delay between videos. I'm grateful for your patience and sticking around for this channel. We deal more with quality and not quantity, but certainly the quantity side of things has been lacking, so I hope this more than makes up for it. Here's the outline for today. We've got a disclaimer, some general remarks, defining market structure, identifying breaks in market structure, trading breaks in market structure, and then we'll finish off with some nuances. Usual disclaimer, I'm nobody, I know nothing, this is for fun. I'll try to keep this reasonably brief. I may or may not have recorded this video without recording it, having spoken to myself for an hour 40 minutes. So here we are, nonetheless. First things first, I'm just presenting my understanding of market structure that I found personally useful. I don't think there's an objective or correct form, and people will feel free to disagree with the terms I use and how I use them, but that's fine. I'm just doing my best with what makes sense to me. It's a topic with a lot of grey areas. Market structure generally, I think, is a tool to provide context, more so than just a mechanical trading system. And it tends to follow the general principle of the clearer and the more straightforward and unambiguous something is, the better it will work. I think a lot of technical trading is like that, with levels and all sorts of things deriving their significance from their clarity, if you will, or how obvious they are to the largest number of participants. Generally, with these videos, I like to just signpost versus just tell you stuff to absorb and apply. Sharing ideas, and if you find some of it useful, great. You don't need to believe or subscribe to all of it by any means. Oddly enough, I have to clarify this, but examples are deliberately cherry-picked to present the concepts as clearly as possible. This isn't a trading highlight reel. I just pick the stuff which I think looks clearest to convey a certain point. Finally, I'm very grateful to everybody who reaches out and asks where to go or what to do once they've finished consuming this content as well as the articles. My answer is practice, practice, practice. Specifically, actually trading and posting up charts and acting on ideas and making notes. Unfortunately, or perhaps fortunately, there's no replacement for screen time. So at the end of the day, you have to put the hours in. And there's only so much reading you can do until you just start going around in circles and wasting time. If you appreciate the technical analysis series, if you've ever learned anything from any of these videos, make sure to like this video and subscribe to the channel if you haven't already. Thank you very much. Let's get straight into it. Again. Some terms we'll be using. The acronyms are fairly self-explanatory. Market structure, higher low, higher high, etc., etc. You may want to just screenshot or keep these in mind, but shouldn't be too hard to remember. So section 1 is defining market structure. My definition is a sequence of proximate highs and lows in a given instrument. And that sequence varies depending on whether the market is bullish or bearish. For bullish market structure, we generally expect to see higher highs and higher lows. For bearish market structure, we generally expect to see lower highs and lower lows. This begs the question, which highs and lows, as there are many, are suitable anchors for ascertaining market structure? Generally, and as you may remember from the FIB video, we give significance to swing highs and swing lows for market structure anchors. They can be defined in the following manner. A swing low is a low with a higher low on both sides, and a swing high is a high with a lower high on both sides. So a low sandwiched by higher lows, and a high sandwiched by lower highs, if you will. There's no single formula, in my opinion, for choosing which highs and lows are valid for market structure. There are a number of factors to consider when it comes to arriving to the decision of what's a valid swing high or low to choose. Here are some you might want to consider. Recency is important. Significance and size of the move following that high or low is important. Again, revisiting the concept or the principle of greater clarity leading to better outcomes. If you have a bigger, more significant swing away from the level, it's probably going to be better and more significant and meaningful generally for your trading as well. The basic smell test, of course, is what's the most obvious or outstanding high or low. You probably can't go wrong with that. And if it doesn't look like a clear swing point from first glance, it likely won't be the best structure. So again, going for the so-called low-hanging fruit is actually pretty wise when it comes to this type of technical trading. As to the question whether market structure and trend are the same, I would say they're not. They're somewhat complementary and can be used in a similar fashion. I don't think you need to pick between one or the other, and I don't even think they conflict a lot of the time. So for example, you may have a high time frame bull trend, which sees a low time frame market structure break, and it's not like you have to pick which one is correct. They both provide different types of contexts, and in that case, with the low time frame breakdown in a high time frame uptrend, that could just lead you to the conclusion of a potential opportunity to buy a dip. Here's the diagram version of the swing high and swing low. As you'll recall, swing high, lower high on both sides, swing low, higher low on both sides. This should say higher low, not high low, but it's been one of those days. We talked a lot about filtering swing highs and swing lows. Even if we just take the basic definition of low with a higher low on either side, high with a lower high on either side, with the daily time frame chart, which is supposed to be the cleaner, slower moving one, this is my quick markup of the swing highs and lows using that definition. There's a lot going on. If you were to draw levels on every single one of these highs and lows, it wouldn't be the most useful and actionable chart in the world, even though it is pretty high time frame. You can only imagine what an intraday chart would look like, which is why, in my opinion, it's important to continue paying attention to these considerations for choosing highs and lows, as opposed to just blanketly selecting all of them. I think some selectivity and some sort of quality filter is definitely helpful and will make things more actionable. So some further things to consider. Is the swing high or low you're assessing confluent with another key level? Is there more going on at that level that will attract the attention of further participants? Is it a nice support resistance level with multiple touches? Is there a candle open there, like the monthly open, weekly open, daily open, etc.? Is there just a good reason to have eyes there? As was betrayed by the previous chart with all those nice arrows, in any given market on any given time frame, you can almost certainly find structure that qualifies as an MSB. That in itself does not make it worth trading. And that is the reason why we have those quality filters, so that when we have higher highs and higher lows, or just market structure levels more generally, that they actually mean something, as opposed to having a ton of overlapping levels generating a lot of noise and very few signals. As for further quality filters, if in doubt, SR it out works quite well. So by definition, horizontal support resistance is derived from old highs and lows. If you can identify at least decent levels, so you've got some prowess in support resistance identification, you can automatically identify meaningful market structure levels, or at least your job is easier. It also works for trend lines, given the sequence of higher lows and lower highs. Those make up your uptrend and downtrend line levels as well. So if you've got a nice trend line and it's broken, good chance you've got a market structure break on your hands as well. The more eyes, the better. A quick note on candle bodies for market structure. Bit weird, but something I use, so I get questions about, and people generally love the topics of wicks and bodies. So it's unconventional, but I personally use them. I find they work better on high time frames and or at swing points, where the wick may make things a bit difficult or some sort of outlier. I'd just say test for yourself and be consistent. There's no right or wrong way, in my opinion, as long as you're not forcing narratives on the chart and being selective based on other biases. So we had this chart earlier with every single swing high and low, and then this version is maybe the higher quality or filtered one, where I've opted to choose the swing highs and lows that I think are really outstanding and significant on the daily time frame. And as you can tell, there's just more room between levels, easier to read, and that tends to translate into more actionable ideas and signals also. You can do this exercise yourself, pick any market, any time frame, maybe something you've never looked at where you don't trade, and just delineate using, again, the basic definition of swing high and swing low, what you think are the clearest or most outstanding levels that are available. Unlike most things, I found that the less you think about this, the better the results, and of course with time and practice, it'll become second nature. Still on defining market structure, difficult question. Is there a single unified market structure per time frame? We can compare this to trend. Let's say the 200 daily moving average is your key for directional bias. In most cases, unless the market's just chopping up the level or it's really close, whatever, but in most cases, you'll be able to look at where price is relative to that 200 daily moving average, and it will give you a pretty unambiguous answer as to whether the market's bullish or bearish. If it's above it, it's bullish. If it's below it, it's bearish, right? I think market structure doesn't lend itself well to that type of uniformity, which isn't a bad thing. I think the assessment or your assessment of market structure will depend on how strictly you define your criteria for valid swing points, and that will of course affect the types of trades you want to take. So let's say you're on the looser side of the spectrum and you just map every single swing high and swing low as in this example chart, then you will have many types, many market structures going on at the same time, depending on which swings you're paying attention to, and then you'll have short-term breakdowns, but longer-term higher lows, etc., etc. Whereas if you're more on this side of the spectrum where you're conservative and far more selective about the swing highs and lows that you choose, you may get fewer market structure signals going on at any one time. But even if you have the cleaner daily view, you could have shorter time frame daily market structure breaks, even if your daily market structure levels are intact. So again, it's a bit of a mixed pot, and I think it really depends. I don't think there's one market structure. It just depends on how strict you are with your guidelines. The stricter you are, the less noise you will have, so maybe less going on at the same time. But if you're very strict with this is my market structure level and everything else is noise, then maybe at times you will have a clear read as to this is the market structure on a given time frame. I just don't think it's a totally useful way of thinking about things. So for example, it's totally fine to say that high time frame market structure is bullish, but the low time frame market structure has been broken, even on the same time frame. So if you look at a chart and you think, well, yeah, you've got a higher low here, but this is a lower low, and oh my god, do I have to pick and choose? The answer is not really. The third point is pretty important. It'll become apparent as we continue more in discussing setups and identifying market structure breaks, but do not chase every market structure break. This is something to have in the back of your mind as we go further into the content. If you end up ascribing significance to every single shift in market structure, you are turning yourself into nothing more than a breakout and breakdown chaser. If that's your strategy, fine, but it's got very little to do with how we want to use market structure as a tool to provide context and maybe derive some setups as well. I mean, by definition, even if you have like a bullish dip or a higher low, that implies that market structure was broken on some time frame to make price go lower, and vice versa. So if you're always like a cat chasing a dog chasing its own tail type of thing, and pretending you're doing so under the guise of market structure, it's generally not going to lead to the most amazing outcomes. So identifying breaks in market structure, now that we've identified what market structure is, my definition is a shift in the sequence of highs and lows in the opposite direction. So for a bullish market structure break, it is when a sequence of lower highs is violated by a higher high. And of course, for bearish market structure break, it is when a sequence of higher lows is violated by a lower low. Just very quickly, I know I said that I wouldn't profess to teaching some sort of orthodoxy or this is how market structure is, but even with my pretty straightforward and simple definitions, there are some criticisms and alternative views to be aware of. So for example, you can see that for my bullish market structure break definition, you just need a higher high, right? Lower high, higher high, and that event in itself is valid for breaking market structure. There are some schools of thought which argue that the higher high in itself isn't enough, and you need a higher low before the higher high for that to be a valid break in market structure. So slightly more stringent requirements. Again, it's not the case of this person's right, this person's wrong, and this is how I do things my way or the highway. As with anything, it's just personal preference, trade-offs, and what works for you. My personal view is the requirement of a higher low before a higher high is just pretty conservative, and also just more burdensome. The second kind of criticism to be aware of, with regard to my definition of market structure offered in the first bullet point, is that there's an alternative view that the lower high that's broken must have preceded a lower low to be valid, or the higher low that is broken must have preceded a higher high to be valid. So you can see in my definition, I don't ascribe any special functions to the higher low to the lower high or the higher low that get violated, but some schools of thought or practitioners of market structure will ascribe certain features to these highs and lows in order for their break to be valid. Again, I think it's just needlessly complex. You can just see how simple my definition is compared to all the other caveats. Simple isn't always better, but in this instance, I feel like it's beneficial. And I still integrate similar logic for setups in terms of how significant is this high or low, but I think it's unduly restrictive, and some obvious market structure anchors just don't meet this strict test. Ethereum Bitcoin on the weekly time frame comes to mind. So this is it, right? And Donald and I in Technical Roundup wrote about the break in weekly market structure when we had this higher high on the weekly time frame. So we had this swing point, okay, and then it closed above it. You can see high, lower high, and then higher high relative to the last one here. So this for us was a break in market structure, right? This bit of price action closing above the level, and we managed to catch or be prepared for the move that was to follow. If we were to take an overly strict definition that the broken high must have led to a lower low, then if we just look at where this leg down went, it technically made a higher low to the preceding one. So not much good there. And even if we take probably one of the best and most outstanding swing points on the chart all the way up here and assess whether it's valid for a market structure anchor, if we look at the leg down that came as a result of that swing, technically it didn't make a lower low either. So that would mean that this, under some interpretations, wouldn't be a valid market structure level because it didn't lead to a lower low. Again, not saying one is right, one is wrong. I just think it's unduly stringent, and I think I'll just have an easier time making this video, both with stuff that I actually trade, how I view things myself, but also building upon this as a foundation. I think we'll have an easier time. I just wanted to bring in some alternative perspectives, make you aware that if people disagree with you on the internet, it won't be the end of the world. There are different ways of doing things. I'm just giving you what works for me. And as it says in the final point, study your own trades, see what works for you. Maybe integrate mine, maybe integrate another version, both. This is, your toolbox. Customize it as you wish. Some basic home-cooked diagrams for breaks in market structure, again, relying on the basic definitions put forth in the previous slide. We've got a high, lower high, and then the market structure break event is when we have a shift from the sequence of lower highs to a higher high. Right, so the higher high event for me is the break in market structure, specifically the close above a lower high. Some points, as sort of touched on earlier, what's happening at the lows is less relevant for me when it comes to bullish market structure. I want to see evidence of what's going on at resistance and higher prices to be focused on the bullish side, so that's just my view. And the same for the bearish side, or similar logic. You've got low, higher low, and again the sequence of the shift, bearish shift in market structure is when you move from higher lows, and that's broken by a lower low. That shift from higher lows to lower low is the break in market structure, or the market structure break. So again, higher low, lower low, that shift is our MSB. Same thing, for me personally, what's happening at the highs is less relevant. If I'm focusing on the bearish side, my focus will be on lower prices and on price behavior around support for the most part, and hence why less interested up here, eyes down here. Some more details on identifying breaks in market structure. We have to deal with the nitty-gritty, wicks or bodies. People seem fascinated with this topic. It's not too relevant, but I'll happily entertain it. In most cases, just as a general heuristic, if you must ask yourself whether market structure break has formed, it probably hasn't, or at least a very clear one hasn't. As for wicks or bodies, there's no right answer, in my opinion, as long as your framework for ascertaining them is consistent. That is to say, ascertaining breaks in market structure. So some common variants of kind of wicks or bodies and candle closes, all that type of stuff, is using wicks to delineate market structure, and a wick above or below constitutes a break. So no requirement for a close, just wicks through swing highs, wicks through swing lows would constitute a market structure break. I've seen that. The second one, I think this is probably the most popular one, using wicks for market structure, so swing highs and swing lows, the actual wicks and the candlesticks, and then closes above the highs or below the lows for market structure breaks. This is the more conservative one where you're using the extreme for the high and low, and then you want a full close through to get some sort of confirmation. So that's pretty popular. And then my preferred variant is using candle bodies for market structure, and then closes, so again bodies, above or below for market structure break. No magical reason, not saying this is the real way to do it, secret voodoo, whatever, just something I've done and what works for me. I was using candle closes for levels and it just basically transplanted it to market structure, and I didn't feel hurt by the decision. But again, look for yourself, maybe your market's different. If in doubt, context will often dictate what's reasonable in exceptional circumstances. I've got the example of Bitcoin having this 14k wick, and well, was market structure broken on the 12k break or on the 14k break? Like if you have those anomalous wicks which are clearly far away from where most of the trading was done, and the candle bodies just have the nicer levels, and like a lot of the time it'll be pretty obvious. So by all means be consistent, but no need to be a zealot with these things. You'll know a breakout and a breakdown when you see one, and if you're having to split hairs by looking at wicks versus bodies, then maybe it's not as clear-cut as you've thought. As for candle closes, as we discussed the common variants, it's, wicks above or closes above, below, etc. I'd say watch the timeframes video. Generally, it's helpful for this video as well. But as a safe rule to roll with, I at least like to see a close above or below on the same time frame as the market structure anchor. So if I'm looking at daily market structure and I've got my swing high or swing low set out, I want to see a daily close through that high or low to constitute a market structure break type of event. Otherwise, it's just kind of a retest of support resistance or some other weird stuff, and it also just makes things very easy to interpret consistently. You're not having to look at random timeframes and weird price action. You have the market structure level from a certain time frame, and it's broken when that same time frame closes through it. Pretty straightforward, and the market, at least crypto markets, seem generally comfortable with this implied consensus around candle closes, so until that changes, I'm totally fine with it. So identifying breaks in market structure, again, this isn't focused on trading market structure breaks, which is the third section. This is more, once you've identified it, what can you do with that information, or perhaps what you shouldn't do with that information. So directional bias is a big one. I strongly recommend watching the video on, not the video, this kind of is the video, but reading the Medium article on directional bias. I'll try to link that in the description. If not, just search CryptoCred directional bias. It's a Medium article, but the basic outline is as follows. It may seem fairly self-explanatory, but of course, the upcoming slides will build on the content in the slides that come before it, so bear with me. And it's also good for beginners. So for a bullish market structure break, we're essentially anticipating a higher high with or without a higher low, right? So you've got the bullish market structure break, the higher high is formed, we're anticipating higher prices, usually in the form of another higher high, and whether it pulls back or not, hence the with or without a higher low, we don't know, but generally that's a bullish outlook. Buyers are in control, resistance is broken, however you want to slice it, and we're favoring long side trades. And that also means that short side trades are counter trend, right? Bearish market structure break, as you can imagine, is the opposite. You have a bearish market structure break, that's a lower low, support is broken, and we're anticipating lower prices with or without another lower high. Again, we don't know how or if the market's going to pull back in those cases, and that's a bearish outlook. Generally, once you have that bearish break in market structure, assuming lower highs and lower lows and favoring short side trades, or if you're long only or in other circumstances, you could stay out, take profit, hedge, or do whatever it is you do to mitigate exposure in those cases. And as per the last point, jumping a little bit, market structure breaks don't always have to translate into a trade. It can be used, or they can be used as signals in their own right. So maybe I'm going to stop longing, I'm going to move my stops, I'm going to take some profit, I'm going to hedge, etc. It doesn't always have to be long this, short this, right? Practical considerations for trading an MSB. And this is just some quick pointers, maybe a summary version of the article, but you should still read it, on trading against a market structure break. So again, bullish break, bullish outlook, but what if you want to take bearish trades, right? Or bearish trade, bearish outlook, but what if you do want to get long? There are some things to be aware of if and when you find yourself in those counter trend scenarios. And again, all my personal views, opinions, and so on. The first of all, the basic overarching idea is if you're trading counter trend, you're trading against the current, so to speak. And therefore you have to be more defensive and less liberal with those positions because the odds, so to speak, to use that term very loosely, are against you. What are some of those considerations, or what might those considerations translate into during a trade? Well, shorter holding periods, for one, more conservative targets, closing trades at FTA, first trouble area, greater minimum risk reward requirements, usually with closer invalidation, not wider targets. So let's say typically for a trade, you will have a requirement to offer at least 1.5 reward for every unit of risk. And then for a counter trend trade, because the current, so to speak, is against you, or the probability of that side of the market being correct or rewarding you is lower, you kind of build that in to your trade parameters and require, let's say, 2 reward for 1 risk instead of 1.5. So the payoff has to be worth it, or there has to be a higher chance of a greater payout than usual in order to justify trading counter trend. And again, small nuance point, it usually comes in the form of closer invalidation, which is much more reasonable and playing much more defensively as opposed to picking wider targets. You don't want to artificially inflate your risk reward by going for wider targets instead of looking for opportunities close to invalidation, which kind of goes hand in hand with shorter holding periods anyway. Further, more active trade management. The whole idea of letting winners run is more trend following and trading in tandem with the trend, that you don't overmanage positions that are just going up generally if you're long, etc., etc. Whereas if you're counter trend, you need to be a bit more dynamic and not allow your evolving R, so to speak, to deteriorate. So, these trades, because they're counter trend and lower probability, by definition, sort of require more babysitting. Different sizing is also another consideration. We like to bet bigger when we're on the right side or on the easier side of the market. And if we're making our job unintentionally difficult by going counter trend, that typically warrants some sort of sizing adjustment in many cases. So obviously smaller or more conservative. Just some very quick points there. You can always flip those around when trading in the direction of the market structure break, right? So if you're trading with the trend, so to speak, those would be longer holding periods, more liberal targets, maybe lower risk reward requirements, less trade management, more hands off, and larger sizing, all else considered. Just some points to consider. Still focusing on the benefits we can derive from identifying breaks in market structure outside of trading the actual breaks in market structure. This is a very useful one because I know a lot of the audience will be levels traders or paying attention to levels in one way or another. Market structure can be used to filter good support resistance levels and structures from less good ones. So it's a great use case for those struggling with level selection, be it your levels just getting chopped and not being price sensitive at all and not being respected by the market, or if you just have too many and trading level to level becomes impossible simply because you've got a level every 1%, right? So what's the basic premise? How does market structure help us find better levels? And this comes down to what can we expect from good resistance and good support, or what are some of the behaviors and types of market structure development that we can use to find good levels. And we're essentially working backwards, right? So we look for the break in market structure, and then we're jumping and thinking, where did that come from? And the origin of those market structure shifts is where we'll find our good levels. So the basic outline is as follows. Resistance, or a high that preceded a bearish market structure break, which is a lower low, is strong resistance. And support, so a low that preceded a bullish market structure break, a higher high, is strong support. To use more colloquial terms, we're essentially asking the level itself for its CV, a kind of list of achievements. Like, okay, so you've got this high, what did it actually do? Why is it significant? Why is it better than any other high? Well, this high preceded a break in market structure. So the market reached this price level and then made a lower low. Okay, well that's a bit more significant than the market just reaching that high and then doing nothing. And the same for support. Why this low? Why this support? Well, the bounce that followed made a higher high and shifted market structure. Okay, well that's a bit more significant than other levels perhaps. And this type of logic is applicable to all support resistance structures and similar stuff generally. You'll see it applied to supply demand zones. Like, this is the supply zone and the move away from it broke demand, so it's significant. Or this is demand zone, move away from it broke this supply, so it's significant. Kind of second order thinking makes sense, right? I'd say it's particularly applicable for range trading, where retests are deeper and or higher lows and lower highs are less pronounced. When you really need to zero in on like a range low or a level, this type of stuff can help. Here's the TLDR, and memorizing this is going to be important for our reversal setup, but a high that forced the lower low, forced, preceded, doesn't really matter whether you believe in the causation side of things. It's really irrelevant. It's just structure we're interested in. But a high that forced the lower low is significant, and the low that forced the higher high is significant. Again, we see the shift in market structure. That's significant, and we work backwards to find the level, so to speak. Here's the home-cooked diagram version, right? Strong support. We're almost working backwards. So you've got the high, the lower high, higher high. Okay, we know that's important because the higher high is the break in market structure. That's some serious stuff. Where did it come from, so to speak? We're tracking it on Ancestry or whatever data mining website you use, and we work backwards and see this was the swing low that broke market structure to the upside, right? Or the market structure shifting move originated from here. Even if we compare it to its neighbor, let's say this swing low, okay, well that's potentially good support. I mean, I know in this case the levels are lined up, so it's not terribly compelling, but just for the sake of argument, this swing low, you got a bounce, but that bounce resulted in a lower high. Not as impressive, whereas the move from this low resulted in the higher high. Okay, now we're in business. I think the same logic can be applied to resistance, of course, whereby we were working backwards, we see this shift in market structure, low, higher low, lower low. Okay, something clearly happened here. This is significant, the shift in behavior, and let's work backwards. Where did this lower low and market structure shift come from? And this is the high that preceded the market structure break, or again, to use that type of language, the market structure shifting move originated from here. It's like, well, what did this high do? Yeah, it led to a sell-off, but it was a higher low. This is the one which shifted market structure. So the level kind of derives additional significance from the fact that it moved things around a lot. This is an important bit, identifying breaks in market structure with regard to entry triggers. And market structure breaks can be used as an entry trigger, or MSB can be used as an entry trigger when trading at, and in brackets, high time frame structure. It doesn't have to be high time frame structure, but that's the most common use case. What's the basic premise? Well, this seeks to address the common question of, well, how do you know this support's going to hold? Or how do you know this resistance is going to hold? Which I think is generally impossible to answer. And the answer itself is actually quite boring as well. You don't. So, you either take a guess or you develop a case based on evidence in price action as it develops, right? Or you just go in with no knowledge and the risk reward and the payout and the probability, etc., justify a blind entry. But for our purposes, if we simplify things a bit, how do you know the support's going to hold? Well, what would be good evidence of support holding? Well, a bullish break in market structure would mean that buying is going on at the level. So, that's pretty good confirmation as far as those things go. Same for the bearish side. How do you know this resistance is going to hold? Well, I don't know if it's going to hold, but if market structure starts to break down, then that's good reason to believe that sellers are selling the level. So it's doing something. So I don't know for certain, but at least it shifts the odds in that direction and in my favor. So the basic premise, bearish market structure break at resistance for sell setups. We want to see selling at resistance. Bullish market structure break at support. For buy setups, we want to see buying at support. It's most commonly used in multi-time frame trading systems. So this is your kind of top-down stuff that you'll see pretty frequently, whereby you'll start with the high time frames, like weekly, daily structure, as an area to do business. Like this is the support I want to buy, resistance I want to sell, usually based on, again, high time frame levels, structures, what have you. And then there's a low time frame market structure break as the trigger for the trade. So this is the daily level, and I'll get the hourly lower highs and lower lows. That'll be my entry to short. Or this is, daily support. I'll wait for 4 hour lower highs, 4 hour higher highs and higher lows, and that'll be my trigger to buy. It's important to note that this time frame logic is often scaled down. So you'll see 5-minute, 15-minute entries at even intraday levels, and it's more the hierarchy of timeframes that's relevant, that you derive clues about higher timeframe structure from the price action, specifically market structure on lower timeframes. Some important notes, and this is something I've been thinking about a lot, both just throughout my career and also the people that I've learned to trade from, etc., etc., and I think it's relevant for developing traders. the idea of confirmation it tends to be a golden goose for most people, and it's much easier said than done. I've seen a very small handful of people actually integrate it into their system, Trader SZ being one of them. Go watch his live streams and learn from him. But he's been doing it for, at least 2 or 3 times as long as I've just traded my first market. So there's a lot of experience that goes into that. And he's also incredibly systematic. And he knows what in advance, in very clear, unambiguous terms, what confirmation means, how to use it, when to use it, and the implications it has for his trading system, how it affects his entries, etc., etc. So it's no joke, it's no easy no kind of laughing matter, right? And of course, it stands to logic that if confirmation in trading were easy or accessible, losing a trade would be very difficult, because you'd have a level, and if it confirms, great, you get on board, you get the trade, and if it doesn't confirm, well, thank God, because you missed out. You dodged a bullet on the losing trade. Of course, in reality, it doesn't work that way. My observation, certainly with beginners traders, is that most participants end up being their own greatest enemies in trying to develop a confirmation-based system. It's just searching for certainty in a business where the certainty comes either at a premium or just doesn't exist. And how many times has this happened to you where you've planned a trade, like this is the level, I'm going to buy it, the market comes into the level, you get a bit scared or antsy, you try to outsmart yourself, you start looking at other time frames, other indicators, etc. By the end of it, you've opened the close and trade 20 times, and the result, of course, is your original plan plays out perfectly. Just bounces, and you would have had an easy time just either leaving a limit order or hitting a market order as soon as it hit the level. So there is that risk that trying to outsmart the market in that way, certainly using a lot of discretion like that in execution as a beginner trader comes with its own risks, and there's often just an implicit trade-off with the whole idea of confirmation, if you even entertain it, which is that you'll get good confirmation and a shit entry versus little to no confirmation and a great entry. Not to mention that if you have to wait for confirmation for a lot of trade setups, it will lock you out of some of the best entries and trade types, especially on lower time frames. So that's something else to be aware of. You kind of cut off the potential scope of opportunities if you always have to wait for XYZ to develop. Not to mention that if you really get into granular intraday trading, a lot of the time what you think is market structure developing, etc., if you get really granular, will more likely than not just be noise. And just a couple of big market orders being able to push around your entry trigger system probably isn't the best thing in the world. Perhaps most importantly, there's a risk of creating a poor habit of what's essentially only entering a market once it moves significantly in your favor. And I've tried this. I've tried to develop systems which give me, certainty even at the expense of entry, and those haven't corresponded with great parts and great periods in my trading career. So just some nuances to be aware of. That said, it's not like it's a useless tool, and there's a reason I've included it into the presentation. My preferred approach with regard to using market structure is to essentially preview high time frame price action. So I'll use daily market structure at weekly levels, for example. Instead of having to wait a whole week for a candle to close at structure before getting any sort of information as to whether support or resistance is going to do its job, using daily market structure at these higher time frame levels is a pretty good middle ground compromise to get something faster moving instead of waiting 14 to 21 days to enter a position. And also just generally, and this is especially relevant with Bitcoin at above 20,000 with no real levels left, using daily market structure on its own when the market is between levels is helpful, and generally just for low time frame trading to provide context, very useful tools. But I certainly wanted to touch on that note of confirmation and maybe point out some potential difficulties to be aware of. So we're on to trading breaks in market structure. We've learnt what it is, how to identify it, and also identifying, as mentioned, breaks in market structure and the type of information that can be derived from those breaks. So now we're going to focus on 3 setups once market structure break has been identified. 2 are based on continuation, and 1 is based on reversal. All 3 are contingent on an MSB forming, so they occur after a higher high, bullish break in market structure, or after a lower low, bearish break in market structure. These aren't the type of setups that you take in anticipation of market structure breaking. These are very much reacting after the fact and what happens next and where, okay? For beginners, just to reiterate the terms, continuation means the trade setup is in the same direction as the market structure break. So bullish break, we're looking for continuation trades, which means long trades or bullish trades, and then vice versa. Reversal is for trading the other side of an MSB. So quite literally the opposite. If continuation of bullish MSB is a long trade, then reversal of bullish MSB is a short trade once certain conditions are met. Before we dive into the setups, some doses of realism that I think a lot of trading education skips out on. I try not to do that, but I could have done a much better job in previous videos. So here we are, and this applies generally as well as for, I think, any type of trading, really. Firstly, these aren't fully fleshed out trade setups per se. I'm a discretionary trader, so I'd never kind of force a mechanical strategy down your throat either way, just not how I roll. And we're more focused on setup logic here, which you can then manipulate, replicate, adjust to your own needs, which I think is more helpful, but worth reiterating for some people. Secondly, if you go out actively looking for trades or forcing something on the market, you'll probably lose your shirt. There's especially a kind of excitement based on novelty, and I've been there when you kind of learn something new with regard to technical trading and you really want to get out there and trade it and find opportunities. I think it's good to experiment and participate in the market and learn via doing for the most part, provided you know some basic risk management, but at least be reasonable with waiting for opportunities versus forcing them because you want to try something out, quote unquote. The third point, this applies to setups generally, just always look for probability enhancers. If the market's kind enough to be in a place where you have some sort of confluence, be it the underlying trend, high time frames, technical confluence, funding, OI, whatever it is you use or proven its worth, make sure to use it. A lot of the time when traders learn something new, they'll just strip it of all context and just go out and try it, and if it doesn't work, they ditch it. TA is, not exactly a science, especially this type of discretionary technical trading. If we were dealing with certainties, then we wouldn't be risking like 1 to 5% of our account per trade. That in itself is an admission of the uncertainties that we navigate, so why make things harder than they need to be? If stuff works for you, have these probability enhancers, use them. Don't think that everything goes out the window just because you learned some highs and lows. On that topic, a lot of the time shit just doesn't work. It's just how trading works. Certainly just how technical trading and any type of trading works generally. Just sometimes it's no good. You can even do everything correctly and still lose money, which may seem absurd, and in almost any other line of work it would be, but this is what we deal with. So it's important to kind of have a procedural mind as well as a results-based mind towards these things. We're talking about setups that follow market structure breaks. Of course, there's no guarantee that you'll get a setup after a market structure break. As you may have seen with Bitcoin and just any stuff generally, once you get that higher high or lower low, the market could just full send or full reverse without you. The first setup of the pullback to the market structure level is aggressive. It's basically a retest of the breakdown or a retest of the breakout, but a lot of the time even that doesn't happen. So that's just something to be aware of. There's no guarantee, and there's no system which will allow you to catch every single move in a satisfactory fashion. The next point is there's this idea of cut and reverse in technical trading, which a lot of people take as a given. And the basic idea of that is that, let's say, for example, you've got support and you buy that level of support. And then if it fails, then the idea is that you sell that level of support as resistance and you kind of still make money, right? So you take the trade in the direction that's presented, and if it fails, you take the other side, and that's supposed to kind of mitigate or allow you to claw back some of that profit. What I've seen a lot in developing traders is, and I still put myself in that category to a large extent, probably until the day I stop trading, but nonetheless, in much greener traders, they'll take cut and reverse as a given, that if their long fail, that means their short at that level must work, and if their short fail, that means it's a very good long. A lot of the time, that setup, that logic is sound, that good bearish setups that fail are bullish, and good bullish setups that fail are bearish, etc. But don't take the cut and reverse for granted. Sometimes you just end up in a shitty position, the market just doesn't want to mesh with you, or there's something else going on. So don't assume that you've always identified absolute turning points and that the market's going to be kind enough to let you get in on the other side in any meaningful capacity if your first trade was wrong. Okay? It's fine to be aware of opportunities upon invalidation, and we'll visit some of those, but again, don't take it for granted. Final kind of boring cred point is that harder parts of setups generally is everything except the trade identification. So sizing, execution, management, choosing targets, and emotional stuff, whatever, that's the actual hard part. Now, there are separate videos and articles on those, like the FTA video is really good, trade management video. There's articles on trading psychology and things to do after a losing trade, etc., but they're not covered in this. And so don't assume just because you've understood the basic trade identification parameters of the setups that we're going to cover that somehow that just means you get to trade profitably forever. It's a small part, important part, but small part nonetheless, and the other stuff in that list is definitely necessary and complementary. With that said, let's talk about trading breaks in market structure. Setup number 1 is continuation from market structure level. So the basic premise is as follows, and this is your bread and butter support resistance, which I'm sure many of you are familiar with, but if not, here we go anyway. As you'll recall, the setups discussed here are contingent on the market structure breaking forming. So we're acting after the higher high or after the lower low. So in the bullish case, as a reminder, bullish market structure break requires a higher high, and the long trade, because again, continuation, bullish break, we want to get long. The long trade is taken on a pullback to the broken high. And of course, the opposite is true for the bearish side. Bearish market structure break requires lower low. Once we've had the lower low, we're looking for continuation. So that's the bearish side, because of the bearish break in market structure. And the short trade is taken on a pullback to the broken low. So as I said, textbook kind of bread and butter, support, resistance, broken support, turning to resistance on a retest, broken resistance, turning to support on a retest. Of course, the usual support resistance considerations apply as well. There isn't necessarily a correct high or low to use at any one time, especially if you've got a level which lines up pretty close to other highs and swing points, etc. You kind of have to make a judgment call, and the same discussion applies with regard to wicks and bodies, but there is a general balancing consideration if there is a bit of space between wicks and bodies, that if you're using wicks or just anchors that are closer to market, so closer to the price as it is right now, or closer to the breakout, whatever, you're more likely to get a fill, but the entry may be worse, right? At the same time, using bodies and anchors further from the market, you're less likely to get a fill, but your entry may be better. And as discussed, of course, there are other variants that you get fully filled, you get stopped out, or you don't get a fill at all because the market just moons. But just some balancing to have in the back of your mind. There's no science to it, in my opinion, and I'm not an expert on scaling orders, so I'm not going to profess to talk about that matter. But the basic idea is as follows. Again, this is the easiest setup of them all. You identify the break in market structure, you identify the break in market structure, and then you take the trade on where market structure was broken, right? Invalidation, always important, and in this case, the setup at its core is a support-resistance flip, right? Broken support flipping to resistance, broken resistance flipping to support, so necessarily invalidation will be based on that logic, and the setup's failed if the flip fails. So if the broken support fails to act as resistance and the broken resistance fails to act as support. We've got our homemade, home-cooked diagram here. Again, nothing terribly complex, I'm sure. Let's say assuming preceding lower highs here. This is our high. You've got the break of market structure when the higher high is made. So this is on the close of this move through the high is when the market's technically bullish. That's our break in market structure. We've identified it. Then on the trading side of things, we know that our first option for continuation is trading where market structure was broken. Where was it broken? It was this high, so it's the retest of that high where the long is taken. Just like it says, long trade taken back at the high, whose break shifted the market structure. So when you're up here, I'll ask you, so what's going on? You say market structure is broken. Why? Well, it made a high, it broke a high, made a higher high. Which high? This one. Well, that's it. That's the level for the trade. Fairly straightforward, fairly self-explanatory. Again, pretty fast moving, pretty aggressive considered in most cases. Again, no guarantee, could just pentamoon, but in terms of nearest pullback levels, this is what we're dealing with. The point of market structure break. Same for the bearish side, right? Assuming preceding higher lows, etc. We've got the low, the lower low, right? And this is identifying the market structure level, the low. The lower low, identifying the market structure break. Okay, phase 3, how do we trade this? Continuation, okay, we're looking to get short. Where do we get short? Well, where was market structure was broken? Well, it was broken when this low was broken. So that's our level. Short trade taken, back at the low, whose break shifted market structure? Identify MS, this is our low. Identify market structure break, here, the close below the low, trade taken on the retest of step 1. What's step 1? Well, we identified MS in the first place. So the high, whose break cemented the market structure break, the low, whose break cemented the market structure break. That is that same level where we look to do business on the nearest continuation trade. I'm not going to pepper you with chart examples. That'd be insulting your intelligence. There are so many of these highs turning to lows and lows turning to highs. So be sure to go check those out and see what they look like. The second setup, also continuation. This is slightly more complicated, but this is continuation from pullback level. Okay, the basic premise is as follows, with a reminder that bullish market structure is predicated on higher highs and higher lows, and bearish market structure is predicated on lower highs and lower lows. So as before, bullish market structure break requires a higher high. But now the continuation trade is taken below the breakout point, but above the most recent low. Okay, when we get to the diagrams, trust me, this will make a lot more sense. Bear with me with the text for now. For the bearish market structure break, it requires a lower low, sure. Then continuation trade is taken above the breakdown point, but below the most recent high. It's a bit less straightforward, but the basic logic is as follows. And this is the bullish example, the kind of conversation you have in your head. Using the same steps, right? Mapping market structure, identifying the break, then trading it. So step one, I identified a bullish market structure break. That's bullish, sure. Second, bullish market structure break is predicated on higher highs and higher lows. Fantastic. Third point, the higher high portion is complete by definition because we've had the market structure break, meaning that if the market is indeed bullish, the next dip will form or must form a higher low. Now the final question, this is what this setup seeks to answer, which area / structure, which isn't the breakout level, right? Reminder that the breakout level in this case is, again, where market structure was broken, So which area structure, which isn't the breakout level, is a reasonable candidate for this higher low or lower high in the bearish case. Now, immediately, the question that you might have is, well, in this case, we've got the break in market structure, and that point where market structure is broken flips. It acts as support, that's bullish, and then it acts as resistance, that's bearish, so everything's aligned. If it goes below that, when it should be bullish, or above that, if it should be bearish, doesn't that just nullify the bullishness of the higher high, or the bearishness of the lower low? And the answer is no, right? And again, let's take the bullish example. Price making a higher high and not flying straight away isn't bearish per se. A pullback is still bullish so long as it forms a higher low. Again, the requirement for bullish market structure is higher highs and higher lows. Nowhere does it say that it's higher highs and a higher low only as long as the higher low forms at the breakout point, right? That's just one option. As long as whatever dip follows doesn't make a lower low, it's still technically bullish and meets our criteria. And again, we can come up with a bit of a spectrum or scale here, where the very bullish variant is a higher high into a moonshot. Okay, you get a breakout and it just full sends Bitcoin style. Then you have still a bullish option, which is setup number one, where you get the higher high, retest the breakout, and then moon. That's bullish. Still bullish but deeper pullback option is higher high, dip below the breakout but form a higher low, and then moon, which is the setup that we're talking about here. And then the shite option, the one which invalidates this, is a higher high, dip below the breakout, and then a lower low. And again, for bullishness, we need higher highs and higher lows. So this is not allowed because it breaks the pattern and is no longer bullish. So here's the diagram version of that. Again, might need a tiny bit more thought than the basic support resistance flip. But you have the high, same old break in market structure, higher high, pulls back to the breakout level, which can be very close to price. Like let's say the close was like 1 or 2% through the high, or maybe a bit more, but either way, the retest level ends up being quite close. And then the market falls below the breakout level. Is that a reason to think that the market is bearish, or that this higher high in the break in market structure has been neutralized? I mean, the answer is no. It's still bullish as long as a higher low forms. And the valid area for that higher low to form is anywhere as long as it doesn't make a lower low. So we're left with a lot of space. So yes, the best aggressive continuation, neatest, easiest support resistance flip is obviously at the point where market structure is broken. But with the realities of how these things move, a lot of the time you have to go lower to go higher, and the dips won't always be this shallow. And the point is, a deeper dip is fine and still bullish as long as it doesn't make a lower low, thus keeping the higher high, higher low structure intact. Now, on a very nuanced point, there is space for short-term bearishness when you get this higher high breakout and then a dip back below the breakout point. Because at that point, any new buyers on this breakout above the high, so when that higher high is made, so anyone catching this breakout, they're going to be underwater when this breakout point fails, right? So if your entry was buying the breakout here, and then the market starts falling below the breakout point, yes, there is room for short-term bearishness as the breakout buyers have to unwind. But that doesn't shift market structure as long as the low is intact and some sort of higher low forms on that dip. That's important to understand. Just some more detail on that. And we will cover, of course, what I mean by higher low area or lower high area. It's deliberately vague. And as mentioned in the diagram, idea valid as long as previous low isn't violated. If it's broken, then the higher low, higher high, higher low structure has failed, and that's invalidated. But look, if you have a higher high, as long as it doesn't break the old low, then everything is kind of fair game for a higher low. Just because it didn't happen at the support resistance flip doesn't mean it can't happen elsewhere while still keeping the integrity of that structure intact. That's important to understand, and the reason I'm harping on about it so much is because I didn't have a fun time trading these types of market structure breaks for the longest time, because what would happen to me was the following. Let me get rid of this very quickly to get some diagram space. So what would happen to me is essentially I'd get trapped by that move, which ended up being a higher low, and I'd get bearish. So I'd have a level, right? Let's make this slightly clearer. I'll be very brief here. I have a level, that's a high. It breaks, makes a higher high, and I'm expecting, again, I was purely levels trader, not trading market structure, that if the market's bullish, it does something like this, right? The high, broken, resistance, boom, support, number go up, okay? What would often happen, or happen enough for me to look into it and remember that something just wasn't correct, is the market would pull back to the level, but it would initially close below it, okay? So it would fail to flip at that early, most aggressive level. In my mind, that was bearish. Like really bearish, because I'm like, oh my god, look, this is the trap. Support resistance flip failed. Everyone's trapped above this high. I'm going to sell it all the way down to, you know, 0. Obviously being hyperbolic, but the idea was that the most important thing going on in the chart was the failure to flip this level to support. And so I'd get short on a retest or short on the close, and the market would drift, and then it would get stuck somewhere, you know, around here, and then eventually either stop me out on the trailed stop or just reverse completely, and I'd be wrong. And that would always dumbfound me, because my idea was, look, the support resistance flip has failed. Why on earth is the market bullish? Like, this is the most significant event going on. Whereas with the benefit of hindsight, now understanding market structure, of course, what happened was the market was made high, low, higher high. And while this was in the very short term bearish, that there was a failed breakout above that high, all it led to was a slightly deeper pullback into a higher low. So basically the higher low was formed here instead of being formed here. Is that much more bearish? I mean, not really. It's just kind of bullish with a deeper pullback as opposed to a shallower pullback. So that's the reason I'm giving this so much attention, is because I used to think that price not flipping that level was the be-all and end-all, whereas the be-all and end-all is actually the lower low. And this space in between is fair game where a higher low could reasonably formed. And this fucked me a lot. So trying to avoid people making the same mistake. I think the distinction is made most clear on this slide here. The key event is the market structure break. Okay, that's the overriding narrative. Once that takes place, you simply don't know if the market will pull back, and if so, the extent. To use different terms, the market structure break is an impulsive move, and then the market may continue the impulse, setup number 1, right? So basically nothing, impulse, and then minimal pullback, and then goes higher, right? Or it may retrace the impulse before continuing. But in both cases, as we covered earlier, the idea is either continuing the impulse or continuing after retracing the impulse. But in both cases, these are continuation setups, right? So now with that kind of diagram knowledge and defining things more clearly, setup number 1 is minimal pullback. The idea is the market will use the breakout or breakdown level for continuation, and this setup is focused trading at the market structure break, right? Where was market structure broken? It was at this high, and that's where we trade. That's setup number 1. Setup number 2, meaningful pullback. The idea is the market may need to retrace following an MSB. So this setup is focused on trading the move following the market structure break. Not at the market structure break, but following the market structure break, i.e. the higher low or the lower high. Maybe the most simple way of expressing it, I mean, yes, the focus is on different legs, impulse versus retracement. But if we just take bullish market structure, which is higher highs and higher lows, okay, both being prerequisites, setup number 1 deals with the higher high sort of thing, and then setup number 2 deals with the higher low part of it. Setup number 1, higher high, we want to get on board that breakout and catch the rest of it. Setup number 2, the higher high is formed, we're now fishing for the higher low. Shallower retrace, deeper retrace, both still bullish as long as that sequence of higher lows isn't violated. So no lower lows. Okay? It's just differently bullish. That's the point. For me, if this failed, there was no this. And that's why I lost a lot of support resistance trades and made a lot of stupid decisions. This should make things very clear. Maybe reread it, pause the video, but I think it gets the point across reasonably well. These are just the same diagrams. Setup number 1, market structure broken here, we take the trade here. Market structure broken here, we take the trade here, right? The break and the trade are one and the same in essence. Setup number 2, the break sets the bias, but then we go fishing for the other half. In this case, we go fishing for the higher low. In this case, the break sets the bias, we go fishing for the other half, which is the lower high. Bullish break, if it's bullish, we need a higher low. It's going to go deeper. That's where we look for it. Bearish break, lower low. Not enough to retest the level. It's going to go deeper. We look for the lower high. And again, invalidation, just as a reminder, for the bullish case, it's higher highs and higher lows. If it fails to make a higher low, invalidation. For the bearish case, lower high and lower low. If on this bounce it fails to make a lower high, then the structure's broken and that's no longer valid. Now to the slightly more interesting bit with regard to defining the pullback area. Again, we've taken a lot of liberties in defining it as the higher low area or the lower high area. What does that actually mean? Where do we find this? And a lot of the time there can be a lot of space between where the low formed and the breakout level. So how do we find structure within what could potentially be a big high time frame gap? So defining the pullback area, yes, purely technically, in the bullish case, anything that is below the breakout level but above the last low is valid. And in the bearish case, anything that is above the breakdown level but below the last high is valid. Okay? So I mean, you've seen me explain this in other videos. When you have the break in market structure, right? I suppose the decision tree, you have market structure break, and then you've got two options. One is the support resistance flip, and one is going to be the retrace for the trade. Okay, that's what setup number 1 and setup number 2 is. Market structure break. Okay, what do? Do we have the support resistance flip? If not, this is always closer to market, right? If no support resistance flip, we go for the deeper retrace. That's the most basic decision tree form of that I think is available, and that's what I'm getting at here. So if it's bullish, and we're talking about the pullback level, then by definition, the breakout level wasn't enough. So anything that is below that but above the last low is valid for a higher low candidate. And in the bearish case, again, the support resistance flip didn't work, so we have to go deeper. So anything that's above the breakdown level, but as long as it doesn't make a higher high, is valid. Problem, that's a lot of space, especially if you're using high time frame market structure. So we're looking for higher low, lower high candidates in those areas. So it's a bit of a free-for-all, really, in terms of price action tools. Support resistance structures, high time frame candle opens, moving averages, moving average clusters. I think retracement and fib kind of stuff is really good for this, like golden pocket, 618, etc. For those interested in my personal approach, and again, in the study guide, there's a whole chapter on Fibonacci levels, which just talks about market structure breaks and this exact topic on deeper retraces. Personally, I look for support resistance structures anywhere between the 618 and 786 retracement. Some will know that as the price action OTE type of thing, but just kind of between the deeper fib levels. And there's no fixed answer, really. So for me, I'll map out the low and then the higher high, and then as the market starts pulling back, it's between these levels that I'll look for structure or just a retracement sometimes, even if there is no structure. But ideally, there'll be technical structure there, like some sort of range, a level, support resistance, etc., as well as with being within the bounds of that retracement. And again, we'll look at some examples in a moment, but also the study guide chapter on that has plenty also. An important point must be made about risk-reward considerations when it comes to this. So the deeper price reaches into the pullback area, the superior the risk reward, purely technically, right? So this is because a deeper pullback, by definition, is closer to invalidation. If we're saying, for example, in the bullish case, that X marks the spot, that we're wrong below X, then purely on risk reward terms, the closer you get to invalidation, the greater the risk reward. So the idea would be that this here, so close to the low, is quote unquote the best entry in terms of risk reward because it's so close to invalidation, right? In a similar vein, here we're invalidated if price makes a higher high, because again, bearishness needs lower highs and lower lows. So higher high just isn't acceptable if the market's bearish. As a result, well, if we're invalidated here, then surely this is the best entry available on the chart, and I should just wait for the market to reach these extremities to get positioned. Now, while the logic is commendable, it doesn't always stand to reason. And it really depends what the chart looks like. You have to exercise your discretion. So say, for example, this red rectangle that I've drawn is a great support resistance structure, some sort of confluent retracement level, and there's a demand zone there which looks great and it fills an inefficiency, all that type of stuff. Let's say the market comes into it and then actually closes below the level here. Now, in purely risk-reward terms, I'm now closer to my invalidation, so the entry is quote unquote a better one, purely from a risk reward point of view. But in terms of probability, the likelihood of the trade working out in my favor has shifted not in the favorable direction, or unfavorably, because my best candidate for a bounce has now failed given we closed below the level. So the point is, you need to always consider the context and what do you actually have as a bounce candidate. Blindly trying to get long as close as possible to invalidation, if it means ignoring price action developments like support being broken or resistance being broken, etc., just isn't the best decision in my view. Like, as discretionary traders, the whole point is to take in that type of context. So while it's important to consider risk reward as you get deeper pullbacks after higher highs or after lower lows, it also just needs to make sense to enter, as opposed to, well, I'm about to get stopped out anyway, so I might as well punt, right? Invalidation, as discussed earlier, for the bullish case is a lower low because we need higher highs and higher lows for bullish market structure. A lower low is unacceptable for those purposes. And for the bearish case, we need lower highs and lower lows. So if price makes a higher high, that pattern is broken and it's not acceptable. Some very quick examples. They're not great, and again, sort of cherry-picked, etc. Doing your own research and finding these on your own will always be much more valuable. But there's some retracement examples here based on daily market structure. So support, swing low, whatever you want to call it. I always use candle closes, so that's me. You have the break, identifying market structure, step 1, break in market structure here, step 2, and then we have to trade market structure. So you've had the break in market structure, and we come up with our two options. One is the support resistance flip, which is close to market, and the other one is a deeper retrace. Where's the support resistance flip? Here, absolutely nothing. Market blasts through it and then finds resistance in that pocket between the 618 and 786 retracement. Again, just as an example. Similar type of pattern here. Again, I appreciate this will look somewhat grainy potentially. Turn up that 1440p. But similar level of support I've got here for market structure. So that's step number 1. Identify the level here, close below it. So 1, identify market structure. 2 is the break in market structure. That takes us to 3. Now the market structure is broken. We've got two choices. Is it going to turn at the support resistance flip, or is it going to push us for a lower high? It doesn't do shit at the support resistance flip, so we know this isn't good, and it's going to push us for the lower high. And again, in a similar vein, found resistance at those retracement levels. And in this instance, some extra confluence in the form of a supply zone at 10.3, 10.4K, which was tested here. Okay, I think I've got some other examples. I'm not going to narrate through all of them because, again, finding your own is much more valuable. Similar type of stuff going on in a couple of instances here. You've got the high, you've got the low, you've got the higher high. So again, market structure level goes here, break in market structure here, creates our decision tree. Do we have the SR flip or do we have the deeper retrace? Well, we go back to where our SR flip would have been. No good. The market on this occasion closes right through that level, but bounces off of the deeper retracement and then trades higher. In the same chart, in a very similar vein, with some deeper swings. And again, look, we're picking the really obvious ones, right? There is stuff we could find in the middle, but the really obvious ones, again, will serve us well. We've got the low. We've got this leg up, the high, high, higher high, break in market structure. Okay, so this is step number 1, identifying our market structure point. Step number 2, identifying our break in market structure. Once we have that, we've got our decision tree as before. Do we have the support resistance flip, or do we have the retracement or squeeze, whatever it may be? On this occasion, if we delineate where the support resistance flip would be expected to take place, here we can see that it's no good, actually acts as resistance and travels all the way back, retraces to, at this point, the fib 618 level before ultimately trading higher. Hopefully it's starting to make a little bit more sense than before. If not, maybe leave a comment. I'll try to do my best to explain. I think this is the penultimate example. Big swing high here, right? The top of this aggressive leg. So again, step 1, we've identified market structure. Here, makes a higher high. Step 2 is the market structure break. We have, do we go for support resistance? And again, there are no examples of this, because at least in this presentation, because they're literally all over the place. Any SR flip qualifies, so no point doing that. The retracing one is slightly more less intuitive. So again, SR, well, let's look at it. We've drawn out the level. Yeah, no good. You had the overshoot and then the pullback, so that's not good to go. We have to focus on retracement. In a similar vein, pulls back to this window, which also in this case happens to be confluence with this little supply zone here and this range, etc. So we have the retracement window and also some technical factors to consider. Market bounces, number go up. Again, cherry pick, not amazing examples, plenty of faults, I'm sure, but that's what we're dealing with. Hopefully that's clear. Again, feel free to revisit this. That's setup number 2, where the break in market structure is still the most important thing, and it's a question of where do we fish for those higher lows in the bullish case or those lower highs in the bearish case if the support resistance flip trade isn't on the table. So let's talk about the third setup in trading breaks in market structure. The first 2 were continuation. This one is reversal. So setup number 1, as we discussed, focus on dealing with the impulse at the market structure break level. Setup number 2, the one we just talked about, focuses on dealing with the retracement away from the market structure break level. The reversal setup, of course, in contrast with these, focuses on trading in the opposite direction of a market structure break. So a bit of a mindset shift here. Normally, bullish break, we look to long. Bearish break, we look to short. In this case, once certain conditions are met, we're actually looking to get short on the bullish break and to get long following the bearish break, okay? And the specific factors which must happen for that to be reasonable and not counter trend is getting longer market when a lower high fails to form following a lower low, and getting shorter market when a higher low fails to form following a higher high. Again, if we take our basics with what's bullish, we've got higher highs and higher lows. Once we get our break in market structure, what's invalidation for our continuation setups? Well, if higher low fails, then it's no longer bullish. So of course the reversal setup is the higher low failing after a higher high, which suggests reversal. Bullishness getting invalidated is bearish. Bearishness getting invalidated is bullish. It's kind of the core logic there. So if the market's bullish after a higher high, it should be forming a lower low. If it doesn't, not a good sign. And that's what the setup seeks to capitalize on. Something important is the good setups that fail are often great setups in the opposite direction. Not always. Again, the cut and reverse thing is a good example of that just potentially costing you more money in fees. But when really clear setups are offered to one side of the market and they scuffle it, I don't play sports, but guess that's some sort of interception or something for my American audience. And so there's an advantage in when the other, in instances where the other side loses something advantageous or gives up an advantage. So setup logic in colloquial form, this helped me write this, so hopefully it helps you as well. So red is for the sell setup. Higher high is bullish. Straightforward. Invalidation for bullishness is a lower low, because we should be seeing higher highs and higher lows. If we see a lower low, no good, not bullish. So if we get a higher high, bullish, into a lower low, invalidated, then you have bulls offside. Bulls offside is, or makes for, a good sell setup. We always seek to exert pressure on those who are weakest in the market or in the most disadvantageous position. And when you're getting squeezed, invalidated, stopped out, etc., that's when you are most prone to those types of instances or circumstances. What's the bullish case? Again, the inverse, lower low is bearish. Invalidation is a higher high, because if it's bearish, it should be making lower lows and lower highs. So if we have a lower low, bearish, into a higher high, that's bears invalidated. Bears invalidated or offside makes for an easy time or an easier time for bulls. Again, we're preying on those under pressure or trapped on the wrong side of the market. The diagrams will make this clear again, but bear with me with the text. So bullish setup requires price to break above a high that preceded a lower low. So the sequence would be a high, forms a lower low, and then price makes a higher high above the first high. Bearish setup, of course, is the opposite. You've got, it requires price to break below a low that preceded a higher high. So we've got a low, okay, a low which forms a higher high, okay, that's bullish, right? It goes back to that strong support thing. This low broke market structure, that's sick, it should be strong, but then you get a lower low below the first low. Never mind, strong support has failed, or bullish market structure has been invalidated. And I kind of front ran myself with that third point. If it helps, this can be articulated in support resistance terms as discussed previously. So resistance that forced the lower low is strong resistance, right? Going back to that discussion, why this high? Well, it forced the lower low. Okay, well, that's strong, right? And price closing above it means that strong resistance has failed. And strong resistance failing is bullish, right? Bearish, of course, the opposite. Support that forced a higher high is strong support. Why this low? Well, it forced a higher high, not just any kind of bounce. Okay, that's significant. And so if price then closes below it, that means strong support has failed. Strong support failing is bearish. Think Bitcoin at 6K, for example, or whatever. The underlying logic, whether you want to use market structure terms or support resistance terms, doesn't really matter. We're going to focus on basically the same stuff. But in market structure terms, is that the market structure break failed to offer continuation. Failed continuation is suggestive of reversal. I mean, yeah, or just chop, shit setup, etc. But for our purposes, failed continuation is suggestive of reversal. If we take that to our decision tree, just very briefly, let's say we've got the bullish case, positive. You've got the break in market structure, right? And then you've got one. It's going to make a higher low off of the SR flip, or it's going to make a higher low off of a retrace. This setup says it fails here, but it also fails here because it doesn't make a higher low, it makes a lower low. And so suddenly, bulls are on the wrong side of the market, and that's where we want to take the other end. Okay, so the underlying logic is the market structure break failed to offer continuation. Did it continue off the SR flip? Nope. Okay, did it make a higher low and find find support on a dip? No, it actually made a lower low. Oh, well, shit, well, it's no longer bullish then. Okay? That's why it's bearish, because it failed as a bullish setup to offer continuation. And those participants taking these setups or even taking the breakout are trapped on the wrong side of the market. So here's what that looks like. As foreshadowed in the last point of this slide, this ends up looking identical to setup 1, which is the bread and butter support resistance flip, just with an MSB in the other direction as part of the preceding context. So again, setup number 1 is just this, breakout, retest up, breakdown, retest down. But the reason this is reversal is because of the preceding context in the form of a market structure break in the other direction, right? So this is a bullish breakout, but it's happening after a bearish breakdown. So you've got really positive price action after a bear trap. So more squeeze potential, to use some very loose terms. Okay, so if we follow this kind of in order, we've got the high. So we've got a low formed. Okay, this market forms a low. This is relevant to ground us in terms of market structure. Then you get this high, which precedes a market structure break. Because after this high, you've got a leg down, which makes a lower low. So again, this level's extra significant, extra strong, whatever. Not only is it a high that led to a sell-off, but that sell-off broke market structure. So once this happens, once you get that market structure break from low to lower low, that flow chart comes up of step 1 or step 2, right? Okay, we've got the market structure break. It's bearish. It's a bearish market structure break. So you either sell the support resistance flip for option 1, right? Or for option 2, you sell the retracement or the squeeze. So market comes into this level. Option 1 fails as the market starts to trade higher. Okay, so those sellers and sellers below the low are underwater, are feeling heat. And then the final stand and the final bastion of bearishness is some sort of lower high structure. And then when the market breaks above that and makes a higher high, in either of these cases, be it in setup number 1 or setup number 2 or any sells taken in between, either at the lowest low or just somewhere on the way up, where is invalidation? Where are their stops going to be? And remember, shorts closing or being forced to close at market turn into market orders to buy, so additional fuel. Well, typically, if bears were betting on continuation, they want lower highs and lower lows. If price fails and makes a higher high, they are invalidated and closing those shorts, which become longs at market. So this high, which was amazing resistance because it broke market structure, once it gets flipped, with the added bonus of all this additional fuel at the lows and on the way up, turns into support and facilitates an almighty squeeze in the other direction. So that's the difference. Setup number 1 is just the kind of bread and butter support resistance, resistance support resistance flip, right? There's no other real impetus for participants to be really trapped on the wrong side of this flip. In this case, there is a ton of impetus for participants to be trapped on the wrong side of this flip because there was a break in market structure which induced, to use certain language, those sellers into the market or made that seem like an attractive option. So more people offside, bigger potential for a squeeze. I won't do the same thing here. It's kind of the same thing, right? This is the low which broke market structure. That's significant. Then when it fails, that strong support has failed and all those breakout buyers are in trouble, both on the flip, no dice, and on the higher low, no dice either, anything in between, not good to go, right? And so when the market breaks through that level, makes a lower low, and invalidates bulls completely, any bounce is seen as a good exit. But generally, those positions that are offside, and again, the opposite applies, longs closing at market or being forced to close turn into sell orders, which simply exacerbates or fuels further the move in the opposite direction. So at its core, is this like a basic support resistance flip? Yes. Why is it different or significant? Because you have a market structure break, a fake out in the opposite direction, which leaves more people offside. Kind of extra good. Not just an SR flip with a whole lot of people eating a big plate of not good stuff on the wrong side of it. Some quick chart examples. Again, doing your own kind of homework here is really good. We have a really clean sequence of lower highs on ETHUSD on the 4-hour chart here. Then specifically this swing here is nice. Like, I know I say the high, but really if you just want to box out the candle or just box out the whole leg, jump into one of the live streams and see how we do it there. It's pretty reasonable. But you have this swing up, which leads to a lower low, right? So more sellers in the market. As a result, market structure looking bearish. So you'll have continuation sellers and lower high sellers as well instead. And they're invalidated if price makes a higher high. Because again, they're bearish. They want lower highs and lower lows. But the market makes a higher high and breaks that level. That's it. All those positions underwater feeling the heat. Shorts puking their positions become orders, for the most part, to buy at market. You get the flip. Should have been really, nuked down from here, broke market structure. Man, this should have been really good resistance. Oh, God, it failed. All these guys are wrong. It's strong support. Number go up. Again, whether you want to articulate it in market structure terms or support resistance terms doesn't make any difference. It's the price structure that we really care about. ETHUSD daily. This is the low to high example. We can just box out this consolidation. This is the low, which led to the high, which broke market structure. Should have been amazing penta giga support. Right, break in market structure. Do you get a support resistance flip? Option 1, SR is here. No dice. Okay, option 2, some sort of higher low structure. Right. On the retrace, no dice either. And when that level fails, all the buyers of the break in market structure and of dips that followed are offside, and retests are an opportunity to mitigate that loss, and generally just puking positions with smarter traders taking the other side as well, conscious of that fact. There are a couple of others on here, but I know this video is going on for very long, so I'll try to cut it short. SNX, this is one we discussed on stream as well. So you have your market structure type of anchor here. You can have the close and the wick, whatever. You've got like high time frame support through these lows. It gets broken on this leg, so we kind of work backwards and say, okay, you've had a market structure break. Where did it come from, right? And you look for the upswing, if you will, or the high, which led to or preceded, it doesn't really matter, the lower low. And in these cases, I just like to get the whole consolidation, candle, whatever. Okay, so wow, working backwards, big market structure break. Where did it come from? Came from blue box. It should be strong resistance. Soon as that's broken through, screwed, etc. Right? You just complete flip, full on. That's why it's bloody called a reversal, right? And the same area acts as support, and this ends up being the capitulation bottom. I'm sure you understand by now the logic of the setup. Yeah. So is it a basic support resistance flip? Yes. Why is it important? Because you have a market structure break acting as a trap, period. Some nuances, and make sure to like the video if you've made it this far, and I read every single comment as well. So if you have any feedback, if this helped, if this confused you, anything like that, I would genuinely love to hear from you. But just some nuances to finish up. The first, about timeframes and reasonable expectations. Watch the timeframes video in the technical analysis series if you haven't already. But as a general guideline, you should kind of expect the time frame of the market structure break to have a significant bearing on the size of the move that follows. So you should manage your expectation in line with that type of relationship. Again, to use exaggerated terms, don't expect the well to end over an intraday market structure break. But at the same time, don't expect a weekly market structure break to fizzle out after a couple of days. So expect big things, bigger and longer moves from larger breaks, smaller and shorter moves from smaller breaks. It's probably the simplest way I can put it, but you'd be surprised how many people underestimate the significance of big market structure shifts on high time frames and then overstate the smallest lower low or higher high on low time frames. It's just people have that thing all messed up a lot of the time. So time frame kind of precedence is important, and being aware of the type of move you can reasonably expect is also helpful and will prevent you from turning into one of those market structure break chasers. The possible exception, yeah, the low time frame market structure break a high time frame structure, but even that is just a way of taking a high time frame trade, so the rule still applies. And of course, related to that is that the low time frame market structure break does not cancel a high time frame dominant trend. So selling every single 15-minute red candle in a strong high time frame uptrend is just rough. I mean, the market by definition has to break market structure to make a higher low. So you don't want to be like old cred, constantly selling the higher low because of a level, basically. Stepping in front of a moving train with a plastic straw type of deal. And always consider the context, right? The way you avoid becoming a kind of market structure breakout chaser and just generally not using this tool very well is by stripping it of its context. But if you use market structure as a tool to provide you with clues, evidence, context, then you can navigate the charts with more reasonable expectations based on timeframes especially. So low time frame market structure break and high time frame bull trend, you'll be like, okay, yes, I can expect short-term price action to to be bearish, but I know that in the whatever medium term, that's actually a dip that I want to buy. So I'm not going to hold it into new lows, and I'll scale out when it comes into a higher low area and actually look to build along, etc., etc. Right? You actually have to, use your discretion in those cases, but it really helps. Makes a huge difference. The second nuance, market structure and range. So it's one of those things where it can be a good tool, but when used for the wrong job, surprise, surprise, doesn't feel too great. And it's, again, going back to the theme of stripping tools of context just leads to shitty outcomes. So with regard to ranges, in less volatile conditions, market structure breaks, which are just less obvious or shorter term, or away from the range boundaries where most of the quality, so to speak, trading is done, can just be pure noise, even if it wouldn't be, say, in like other conditions or outside of the range or in trending conditions, etc. So sometimes chop is chop, right? And that's all it is for most participants. So if you have these higher highs, lower lows kind of happening in the middle of nowhere, especially outside of the range boundaries or extremities, it'll probably mean low quality opportunities, and the market could just keep floating around and could continue to avoid being impulsive until one of those boundaries is reached. So I wouldn't put too much stock into those market structure breaks in a range outside of parts of the range that you'd actually trade, typically being the top and bottom of the range, slightly above, slightly below, and maybe the range midpoint if it's appropriate. As implied by as stated by the third point, I think best practice is to focus on market structure breaks at the extremities rather than chasing every higher high, higher low. Sorry, higher high, lower low, so market structure break at the range midpoint. It's just, I've done it, it's not fun. Thought I was clever kind of trading the range in quarters. Seen Trader SZ do it. I think not easy. And where does that end up? It means bearish market structure breaks at the top of the range, right? The idea of bearish price action at resistance, bullish MSB at the bottom of the range, bullish price action at support, and then you'll do yourself a favor by not losing your shirt trying to force your view at mid-range or just well away from those boundaries. Third nuance, a bit thin on this one, but just something worth grazing over. Failure to continue versus just market structure shift. So again, a benefit of market structure versus just levels is that it gives a lot of weight to recency. Not that levels don't, but really how price action is developing there and then. I think market structure is, despite its overlap with SR, I mean, it's the same thing in a lot of cases. But whatever, it's a good tool for how the market is like right now. And this can provide early hints of trend reversal or a slowdown more generally, even if market structure isn't broken. So specifically, there are little shifts in behavior that you can spot which act not as signs of reversal or something to act upon or a setup, but as little, gaps in the armor or red flags when you've got a dominant trend or market structure. So a bullish example is when, or signs of a sign of bullishness slowly emerging is when you've got clear lower highs and lower lows, right? Except those lower lows then start to form equal or higher lows. So again, bullish market structure needs a higher high, but if it starts moving from lower low to equal or higher low, it's not bullish per se, but it's less bearish, right? And that information itself, the twisting of the dial more gradually is still useful. And of course, the bearish example is the opposite. You've got a really strong trend, market structure, whatever, clear higher highs and higher lows. And then the highs start to form equal or lower highs. Again, it's only bearish if, at least in this version or how I view things, if you get a lower low. But the fact that you've moved from higher highs to equal lower highs is a sign of a slowdown in the bullish momentum. Again, not fatal by any means. It could just be literally consolidation before another leg higher or lower. But a lot of the time, waiting for a clear market structure shift before shifting bias is just too late. And you get like blowout candles and you get carried out. It's just not fun. So having some sort of early warning system is the term used here, which I think is applicable. Some sort of, early red flag, caution, hey mate, take a look at this for changes in market structure before market structure breaks, I think is useful. And so for me, monitoring those highs and lows, slowly kind of becoming less impulsive, is just a useful way of having a pulse on that. Again, it's more trend slowdown rather than reversal, but a lot of the time it's much better to it'll stop you from getting oversized at the end of the trend, or at least put reversal on the radar. Something to be aware of. And this just helps, I think, with a lot of conjecture you see on Twitter when you say something. People argue that something's bottoming out or topping out. A lot of the time, they have good reasons. Sometimes they don't. And if there's any indication that a dominant trend is at least slowing down, you should be able to see these changes, subtle differences in market structure, if those views are correct. So again, it's failure to continue. By that I mean failure to continue making lower lows if the market is really bearish, and failure to continue making higher highs if the market is really bullish. So subtle shifts. Thank you for watching. I'm glad you made it this far. If you have, I appreciate your patience, both in watching this video, but also in sticking around for my content on YouTube, Twitter, whatever it may be. I'm very grateful for your audience. Be sure to like the video and subscribe to the channel if you haven't already. Again, leave a comment, even if it's short. Any insights, feedback, I'm exceptionally grateful for, and I'd love to hear from you. Although I may be inactive on the CryptoCred YouTube channel, I think it's just because the bar is set so high with the technical analysis series. I do upload weekly on Technical Roundup, including live streaming every Monday and on most Fridays, as well as a free newsletter. So there is a lot of content. And if you want to ever discuss these videos or get an up-to-date live view of the concepts we discuss, I'd love to have you visit one of the live streams to come and chat. So all the links to the slides, to the other videos, articles, Technical Roundup will be in the description. Thank you again so much for watching. Hope to hear some feedback from you. If not, thanks anyway. Take care, trade safe, and I will see you for the next one.